Just a quick disclaimer, this video is meant purely for educational purposes. It is not financial advice. Please consult a qualified financial advisor before making any investment decisions. Picture this. You're waiting for your food delivery and doom scrolling about Nvidia's latest record-breaking market cap. Suddenly, a veteran investor says, India's own Nvidia could be eternal. What? Can a company that brings samosas to your doorstep be compared to the chipmaker powering the AI revolution? Let's break it down. Hi, welcome back to Money Make Insights. That surprising line was uttered by Raamdeo Agrawal, the co-founder of Motilal Oswal. Agrawal believes that the next wave of wealth creation will come from digital businesses. In a Business Today interview, he explained that value migration towards digital firms is inevitable because their products are replicable, friction-free, have near zero marginal cost, and can scale massively. He noted that digital companies could dominate wealth creation between 2022 and 2032. In another conversation, he pointed at Zomato, recently renamed Eternal, saying our Nvidia is probably Zomato. So why does he see parallels between an Indian food delivery app and the world's most valuable chipmaker? Let's decode the analogy and check whether the fundamentals justify the hype. The backstory, from foodie bay to Eternal. Eternal's journey reads like a Bollywood script. It started in 2008 as Foodie Bay. By July 2010, the company had become Zomato and later changed its name to Zomato Limited when it went public in July 2021. The platform initially focused on restaurant discovery and reviews, then pivoted into food delivery, dining out reservations, and subscription programs. Over time, it added B2B supplies through Hyperpure, acquired quick commerce player Blinkit, formerly Grofers, and launched a dine-out experiences app called District. In March 2025, the corporate entity rebranded to Eternal while keeping the Zomato brand for the food delivery app. The conglomerate now has 4 major segments. Food delivery, Zomato, connecting consumers with restaurants across more than 500 Indian cities. Revenue is driven by commission and delivery fees. Quick commerce, Blinkit, a network of dark stores delivering groceries and essentials. It added 294 net new stores in Q4 FY25 and 243 more in Q1 FY26, taking the total to 1,544 stores and aiming for 2,000 by December 2025. B2B supplies, Hyperpure, supplying ingredients to restaurants. Hyperpure's revenue grew 89% year-over-year in Q1 FY26. Going out experiences, District, a platform for table bookings and events, 1/3 of the going out gross order value. Gove comes from the District app. Decoding the India's Nvidia analogy. 1. Scalable digital business. Agrawal's thesis revolves around scalability. Nvidia's graphics processing units, GPUs, became indispensable as AI workloads exploded. The company's software and hardware ecosystem created network effects and a near monopoly in training AI models. Similarly, Eternal isn't just a food courier. It's building a digital marketplace that serves tens of millions of consumers and merchants. Once the platform is built, the marginal cost of serving an additional order is small, apart from delivery logistics. As Agrawal argued, digital businesses have replicable products and friction-free delivery, which help them scale. 2. Network effects and ecosystem. Nvidia's success stems from its ecosystem. Software libraries like CUDA ensure that developers stick to its chips. Eternal aims to create its own ecosystem. Restaurants depend on Zomato and Hyperpure for orders and supplies. Customers use the same app for food delivery, groceries, and dining out. Merchants advertise on the platform. There's a loyalty program. Every additional user makes the platform more valuable for everyone. Just like more gamers and AI developers make Nvidia's chips more dominant. 3. Multi-pronged growth drivers. While Nvidia rides the AI wave, Eternal has multiple growth levers. Food delivery remains a large TAM. India's dining out culture is still nascent and is expected to grow as incomes rise. In FY25, Eternal reported revenue of 20,243 crore rupees, a 67% increase year-on-year. Quick commerce is the current obsession. Blinkit's net order value, NOV, grew 127% year-on-year in Q1 FY26, and, for the first time, quick commerce NOV surpassed food delivery NOV. Average monthly transacting customers jumped from 7.6 million to 16.9 million. Hyperpure supplies to restaurants grew 89% year-over-year in Q1 FY26, helping the B2B business scale. Going out experiences taps India's F&B and nightlife segments. 1/3 of Gove comes from District. 4. India's demographic edge. Just as AI demand turbocharged Nvidia's chips, India's young population is driving digital consumption. Smartphone penetration and cheap mobile data mean more people ordering biryani or groceries online. Agrawal is betting that this exponential adoption will mirror the way AI adoption propelled Nvidia's valuations. The fundamentals. Is the hype justified? Profitability and growth. Although revenues are growing fast, profitability is erratic. In FY25, Eternal turned profitable with net profit of 527 crore rupees, up 50% year-over-year. However, quarterly profits are volatile. Q4 FY25, PAT plunged 77.7% YoY to 39 crore rupees, despite revenue rising 63.8% to 5,833 crore rupees. The decline was linked to heavy investments in Blinkit and rising infrastructure costs. Eternal added 294 new stores and 1 million SQ foot of warehousing. Around 40% of its 1,301 stores remained underutilized. The contribution margin improved slightly from 3.8% to 3.9%. Q1 FY26, PAT fell 90% YoY to 25 crore rupees, even as revenue surged 70.4% YoY to 7,167 crore rupees. Adjusted EBITDA dropped 42% YoY to 172 crore rupees. Quick commerce investments continued to drag margins. However, the food delivery EBITDA margin rose to 5.0%. The B2C NOV was 20,183 crore rupees, 55% YoY growth. Valuation and ratios. Eternal's stock has surged since listing, making it one of the largest internet platform companies in India. The market capitalization is roughly 2.7 lakh rupees crore. That's huge, but does it justify the fundamentals? Key ratios from Top Stock Research reveal sky-high valuations. Price to earnings, PE 336.17. That means investors are paying over 300 times earnings for a company with tiny profit margins. Price to sales, PS 8.75 and EV EBITDA 103.20, far above traditional FMCG or IT companies. Net profit margin, 2.6%, return on equity, ROE 1.74% and return on assets, 1.48%, all relatively low. Debt to equity ratio, 0.01 to 9, indicating negligible leverage and strong liquidity. Current ratio, 3.52 and quick ratio, 3.47, comfortable working capital to fund expansion. The shareholding pattern also tells a story. There are no promoter holdings. Institutions own 68.93% and public shareholders own 31.07%. This institutional dominance suggests that global and domestic funds see Eternal as a long-term digital bet. Risk factors and challenges. Profitability versus growth trade-off. The quick commerce business is burning cash. Blinkit's margins improved to 1.8% of net order value in Q1 FY26 but remain negative. Management admitted that near-term profits will be sacrificed to chase market share. Underutilized assets. Rapid store expansion led to 40% of Blinkit stores being underutilized. If demand doesn't catch up, these assets could drag returns. Valuation risk. With PE above 300 and PS around 9, any slowdown in growth could lead to sharp corrections. Competition and regulation. Food and grocery delivery is fiercely competitive. Companies like Swiggy, Amazon and Zepto are competing for market share. Regulatory changes, example, GST on delivery, FDR restrictions, could also impact margins. Execution risk. Scaling hyperpure, quick commerce and district simultaneously requires flawless execution. Any missteps could erode trust and margins. So, can Eternal become India's Nvidia? Agrawal's analogy is provocative but thought-provoking. It doesn't mean Eternal will design chips. Rather, he sees it as a technology platform with the potential to dominate a large, rapidly growing market. Like Nvidia during the AI boom, Eternal is operating at the intersection of technology and a structural shift, digital commerce. The company's rapid revenue growth, network effects, and ambitious expansion support this narrative. However, investors should balance this excitement with caution. Eternal's profits are still tiny relative to its valuation, and quick commerce remains a cash-burning business. The company needs to prove that it can translate network effects into sustainable margins. Whether it becomes India's Nvidia will depend on its ability to control costs, convert scale into profitability, and fend off competition. Final take, investing or ordering? For viewers considering an investment, remember that Nvidia's meteoric rise was powered by world-leading technology and deep moats. Eternal's moat lies in logistics, brand, and customer habits, moats that are easier to breach. Its valuation's price in an optimistic future. Any disappointment could sting. As for the rest of us, we can still enjoy the perks of this digital revolution. Next time you order Pani Puri or Sambhar Vada at midnight, think about how your craving fits into a much larger story of India's digital economy. Maybe Eternal will indeed be India's Nvidia. Or maybe it will just ensure that your biryani arrives hot. Either way, keep your portfolio diversified, your stomach full, and your expectations realistic. And that wraps it up. Folks, if you found value in this video, don't forget to hit that like button, share it with your squad, and subscribe for more such finance-packed insights. Until next time, keep learning, keep investing, and remember, your portfolio deserves more attention than your food delivery app. This is Money Mate Insights, signing off.